Today we're going to look at AT&T and Tesla and determine if these investments pose a problem for us investors after their recent earnings. And I think you're going to be surprised at my viewpoint. Now let's first look at my portfolio performance. This is something I share with every single video. I'm up over 3% at 3.11. That's $1,600 in gains. So it's been a very good performing couple weeks for me. I do have 4 companies in the red, and that so happens to be the 4 companies I want to sell out of. And one of those is AT&T, the one we're going to talk about today, and it's in the red almost 18%. So let's start with AT&T and look at their earnings. They basically were in line. The earnings per share was a slight beat at 0.60 cents versus the 0.59 cents, and their revenue came in at 30.14 billion versus the 30.22 billion, so a slight miss. So you had a mixture of a beat and a miss, but they're virtually in line. And so let's look at their sales. The sales did downtrend from last quarter. I will say though that with the economy we're having, this isn't something that's just specific to AT&T. I think we'll start to see this with a lot of companies out there. So it didn't raise a red flag for me. Now their cash flows from operations did drop sharply and are low compared to the last 5 quarters. So yes, that's kind of I think where investors are seeing this and selling out, and it caused the stock to go down pretty heavily after earnings. So with AT&T, I see a company that is more like a utility company, and everybody needs internet and phones. That's just how we work these days, just like everyone needs electricity, gas, water. So I think it's a very stable business. The question is, should I average down now that I'm 18% in the red? I think I might, and there's a few reasons why. One is regarding its debt. Now, the last quarter, they reported their debt increase, which really pissed me off because when they spun off Warner Bros., they promised that they were focusing on debt and their core business. So when I saw it go up, I thought, what are you doing? This is not a good look for you. But now it dropped sharply, and it's the lowest long-term debt holding over the last 5 quarters, so I'm happy with that. Also, I think AT&T is in a monopolistic sector along with Verizon and T-Mobile. It's kind of like the railroads. There's not going to really be a new company that pops up, at least very easily. Of course, the railroads are a lot more secure than this sector with the communications sector, but I will say I think these companies are here to stay for a very long time, which offers that stability. Again, they're like a utility company. The one thing I'll notice with AT&T is every year when Apple releases its phone, they don't offer that great of promos compared to Verizon and T-Mobile. So they need to focus this year on offering some good promotions for those new phones to gain customers because their customer growth is slowing down. So I do not think we have a problem with AT&T. It's just the same old lackluster AT&T we've seen that is starting to change in some areas that are positive, like lowering their debt, focusing on their core business. And I think that one day I will be able to sell out in the green. I just need to be patient. And the fact that this operates like a utility company, because I think people depend on internet and phone usage, I think it's going to be stable and finally kind of start to uptrend in its stock price. I know that's been said for a long time by many others for many years, but once they spun off their Warner Bros. Again, they're focusing on lowering their debt in their core business. And I think after any time a company spins off its business, there's a few years of kind of volatility, but I think that's starting to level out now. And I think we'll see actually some positive trends with AT&T, so I don't think that this company poses a problem, but let me know if you disagree. So let's move to Tesla. This company was similar, kind of in line with its earnings. It had a slight beat with its earnings per share at 85 cents. Actually, it was in line, we'll say, is probably the decimal points after that added the 0.18 surprise, but it's in line, and the revenue was a slight miss at 23.33 billion versus the expected 23.36 billion. Now, where investors, I think, are freaking out is when you invest in Tesla, you're investing in a company that is still treated as a high growth company. So if we look at their cash position, their cash and short-term investments, the more liquid holdings, we'll see that it actually downtrended for the first time in the last 5 quarters, which I think is freaking out investors. Even more so, Their operating net cash flow dropped dramatically this quarter from last quarter and is at the lowest of the last 5 quarters, which isn't a good sign. Now, the one bright spot I want to highlight is their long-term debt is downtrending and has every quarter over the last 5 quarters. And again, the fact that a company is lowly leveraged just gives it so many benefits to survive and thrive during hard economic times. That's why I want to see AT&T's debt go down massively, which it's starting to go down that trend, but Tesla's in a good position here. Now, when it comes to their sales, this is, I think, a big worry with investors, as is for me. So its sales downtrended from last quarter. It was going up every quarter, but now it went down from $24.3 billion to $23.3 billion, so about $1 billion. And its net income is going down, which means, the sales are going down, the expenses are going up, and it's just a tough time for Tesla right now, but yet people are still treating it as a high growth stock. So I'm gonna make an unpopular opinion here. I am not invested in Tesla for one main reason. I think this company has a small moat. Yes, you can disagree. I'd love to hear your opinion. I know there's a lot of fanboy Tesla investors out there, which is fine, and you should be if you have something to back it up with, which share that with me. But I think there's a small moat with this company, and I'm going to prove it to you right now. In their earnings, they show the different areas of revenue, and one is their automotive revenue. That's the largest part of revenue they earn. They also have energy generation and storage revenue and services and other revenue. So these are the three areas of revenue that this company gets. Now, a year ago, the automotive revenue made up 90% of its revenue. That's extremely high. A year, which they just reported, so a year later, it went down, which is good, but it's 86% of its revenue still. The automotive revenue is still very, very high, which to me, this is a car company still. I would like to see that automotive revenue hit a 75% allocation share between the three or below before I would move this up from a small moat to a medium moat. They still have to grow those other areas of their business to make up bigger chunks of their revenue. Of course, I did circle on the very right, the year-over-year growth is pretty good with those other two areas besides the automotive revenue, but that has to happen for years and years and years in order to really offer that benefit of some diversification in its revenue and some safety. So this company still has way too much allocated towards its automotive revenue. That means they're very dependent on the automotive revenue, which I think is risky. And right now, car companies will struggle due to high inflation because not only is it more costly to make your product, but people are pulling back in their spending, and especially on high dollar items. So with that said, there's also competition. Tesla now has more competition than ever before. Every car company is going electric. So it's just not a great environment for a car company. And I just never really liked the car company sector or wanted to invest in it. I got out of Ford a very long time ago. I only held that stock for a very short time, which I'm glad I did. It's just not a very stable, high growth area. And for me, Tesla has some other negatives going on. Their margins are reducing, which means their profits are reducing. They're lowering the price of their cars over and over. They've done it a few times, and it reminds me of Peloton. Now, if you know anything about Peloton, they made gym equipment for your home, and they were looked at the gold standard of all the other companies out there, and they had that status symbol. Well, when they started lowering the prices of their products because they started to suffer financially, it really hit them and diluted them and didn't give them that edge over the other companies. They started to look like another, brand name that is similar in price. It really doesn't stand out in any way. It doesn't hold that status symbol anymore. And this company's been suffering ever since. So I'm not saying Tesla's like Peloton. It's not even close to it, but they are risking kind of going towards not looking like that sought after brand, high-end sought after brand anymore in the electric car area like they have been. They have that risk. So not only the lowering of the prices of their cars is a negative and the margins reducing, but going electric is costly. I know you don't want to hear that, but people are going to start to figure this out more and more. If you have not already and you can't support it, you'll have to upgrade your electric panel in your home to support the charging of a car of a large item like that. And electric rates with the electric companies are going up pretty heavily, pretty quick. And there's complaints all over the country about how their electric bills have gone up massively. I see it on my Nextdoor app. And so that's going to affect the cost of owning an electric car as well. Not only that, but electric cars are heavy vehicles. And you bet you're going to be wearing out your tires a lot more often than with normal gas-powered cars. And so you're going to be replacing your tires more often, and tires are not cheap. So you have your electric bill, maybe upgrading your panel, replacing your tires more. And then if you can't charge at home and you have to charge somewhere else with electric rates going up, that's going to start to push up those rates that you're going to be charged out there, which can get costly, and it might rival someday filling up your car at the gas pump. And not only that, but let's look outside of costs for just a second. There's probably others, but there isn't that confidence in the electric cars at this point for long road trips, which I think prevents a lot of people from buying these cars. It would be like a second car purchase if anything, and still have that gas-powered car for long road trips because there's not the infrastructure quite yet. And with a gas-powered car, there's a gas station, everywhere that you can have that confidence in those long road trips being uninterrupted by running out of the power supply for your vehicle. So for me, with Tesla, in order for it to move from a small moat to a medium or even large moat, it has to prove itself in lowering its dependency on the automotive revenue, which means it has to be proven. It's not a guarantee, and it's a bet on the future. And that's what you're betting on with Tesla, that it's going to grow and expand its ecosystem, its moat, and its products and services. And I would want to compare this to Apple. With its valuation and what people are betting on, it needs to offer an ecosystem that is sticky. If you buy the car, you're going to buy X, Y, and Z. Just like if you buy an Apple phone, you'll probably buy the watch, the AirPods, the Apple TV, the Apple Music, the credit card. Now put your money in Apple's high yield savings account that offers 4.15%, which is pretty attractive. What I'm saying is Tesla still has a lot to prove, and it's still priced as that company with that huge sticky ecosystem and moat in the future, where now I don't think it's there. It has that small moat, and it really doesn't have the ecosystem yet that people are betting on. So with Tesla, I do think we have a problem because its sales are decreasing. It's lowering the price of its cars. Expenses are going up for this company. And it's still, the majority of its revenue is with its automotive revenue, which could really be hurt if things go south with car purchases or electric car purchases. Not to mention, electric car companies really do benefit from all these tax rebates that the government puts out there for companies and individuals, but those can be taken away someday once the electric car market is large enough where they say we don't need to offer this anymore. Whatever the case is, I think there are some problems with Tesla for investors right now, and there's still a lot to be proven, and that's what you're betting on if you're investing with Tesla, which is why I'm not invested right now. Again, I'd like to see their automotive revenue, the allocation, the market share between its other areas of revenue be at 75% or below before I'd consider Tesla. And that to me means it's starting to prove itself. And it's going towards that, and I give it credit for that, but it still has stuff to prove. The last thing I want to point out is in early May, the Fed will meet and discuss raising rates, pausing rates, maybe decreasing rates in the future. It'll give hints at the future, might not. But this is what I think is a problem for us right now. We are either in a buying territory right now or a buying territory after these meetings. One of two things could happen. The Fed can deliver some positive news and the stock market takes off. Or the Fed can deliver some negative news and we see some downward pressure and stock prices and the stock market go down again. If I was a betting person, which I'm not, but if I had to bet, I think that the Fed, the last thing they want to do is paint a rosy, positive picture and risk people starting to spend more and inflation going the other direction than it's been going, which has been down. And so I do not think we're going to see the Fed come out and really give any positive news. More so, I think they're still going to paint this picture of we have a lot of work to do. Inflation is still at record highs because they just don't want to risk all the hard work that they've done and unravel it. So I have some cash set aside. I sold Meta recently, and I'm just going to hold on to it unless if there are some rare presented opportunities until those meetings, but I'm going to hold on to it till after. That's what I'm betting on. I think we'll see some downward pressure after this meeting because I just don't see the Fed painting a rosy picture. I think it's too risky. So we'll see. I could be wrong, but let me know your opinions on me saying that AT&T does not pose a problem for investors and that Tesla does pose a problem for investors, and that I'm betting on a buying territory after the Fed meeting because I think they'll still paint not such a bright positive picture, more of a negative one because they just don't want to undo all the hard work they've done. So I'd love to hear all your opinions. I know AT&T is a very popular stock and Tesla is an even more popular stock. So I think this is one that will create some great conversations below. And be sure to subscribe. I'm somebody that wants to create a family here of people that want to become wealthy, gain knowledge, and just have some diverse content to watch and talk about and discuss. So I'll see you down in the comments. I'll be sure to comment back on any comments that are put down there. And thank you guys very much. I hope you have a great day and see you next time on Mark Arnold's Finance.